Imagine this for a moment. A single room in the White House, 20 of the most powerful oil executives on earth, and a promise that sounds almost cinematic. Total security, total safety, $100 billion, and a nation reborn. President Trump looks at America's energy giants and makes an extraordinary pitch. Rebuild Venezuela's oil industry. Flood the market. Push global prices down. Relieve American families at the gas pump. On paper, it sounds bold, decisive, almost elegant. But here's the tension. Every executive in that room remembers Venezuela as a graveyard of capital. Lost billions, broken contracts, a system where rules vanish overnight. This is where politics meets economic gravity. And gravity usually wins. If you want to understand how power is now being exercised not with armies, but with balance sheets, stay with me. Because this moment isn't just about oil. It's about how far states believe they can bend markets before markets push back. And to see why this offer feels so dangerous to those being asked to accept it, we need to step back and define the real problem at the center of this deal. At the heart of this proposal is a simple but uncomfortable question. Can political power substitute for economic trust? Trump's pitch assumes it can. That if the United States offers enough protection, enough muscle, enough presence, private capital will follow. In this logic, risk is something the state can neutralize by force and authority. But oil executives operate under a different logic. They don't fear volatility alone. They fear systems that cannot be trusted to hold. Venezuela is not just a country with broken infrastructure. It is a country where contracts have collapsed, laws have shifted without warning, and profits have evaporated despite vast natural wealth. For companies like Exxon or Chevron, this is not theory. It is memory. This is why the room was quiet. Why executives spoke of commercial frameworks and legal systems, not pipelines and rigs. They understand something politics often ignores. Capital does not flee danger. It flees unpredictability. And once unpredictability becomes structural, no promise, no matter how grand, can easily reverse it. To see how Venezuela reached this point, we have to trace the deeper history behind its collapse. Venezuela's tragedy did not arrive overnight. It followed a familiar cycle, one that has repeated itself across resource-rich nations for decades. For years, oil was not just Venezuela's export. It was its identity. Revenue from crude funded the state, shaped politics, and replaced the need to build resilient institutions. When prices were high, the system looked strong. When prices fell, its weaknesses were exposed. Over time, power centralized. The state asserted greater control over energy assets. Private companies were sidelined, contracts rewritten, and expertise slowly drained away. Investment declined, maintenance was deferred, and production collapsed not because the oil disappeared, but because the system managing it did. This is the paradox of resource wealth. Abundance creates dependence. Dependence discourages reform. And reform becomes impossible once trust is gone. By the time global oil markets shifted, Venezuela no longer had buffers, only expectations frozen in the past. What remained was infrastructure without capital, reserves without confidence, and a state unable to reverse course quickly. And that brings us to the first real rupture when loss stopped being theoretical and became irreversible. Then came the moment when hesitation turned into withdrawal. For international oil companies, Venezuela stopped being a challenge and became a warning. Billions of dollars were written off. Projects stalled. Partnerships that once promised long-term returns collapsed under shifting rules and political pressure. This was not a dramatic explosion. It was slower, more damaging. Executives watched assets lose value not because of geology, but because governance failed. Contracts no longer protected investment. Profitability depended on political favor. And risk could no longer be priced. That is the first crisis embedded in Trump's proposal. He is asking companies to return to a place where they were already burned twice. This is why Exxon's CEO chose his words carefully. Uninvestable, not unprofitable, not difficult, uninvestable. That word signals a red line in global capital markets. It means no premium is high enough, no promise is sufficient. If you're finding this analysis useful, take a moment to engage, because understanding how trust collapses is essential to understanding how power really works. And yet, despite this history, the proposal moves forward because beneath it lies a deeper mechanism most people never see. What sits beneath this proposal is not optimism, it is leverage. Trump's vision reframes oil companies not as independent actors, but as extensions of state strategy. The logic is subtle but powerful. If private capital will not go where markets fail, the state will redefine the market. Promises of total security are not about profits. They are about control, control over territory, control over revenue, control over political outcomes. Routing oil revenues into U.S. controlled accounts is the clearest signal. It transforms investment into supervision, production into oversight, sovereignty into something conditional. From a political standpoint, this looks efficient. From a market standpoint, it raises a red flag. Because when governments guarantee outcomes, they also reserve the right to change them. Oil executives understand this instinctively. Legal systems matter more than armed protection. Contracts matter more than speeches. And once a project becomes a geopolitical tool, commercial logic is no longer in charge. This is the hidden mechanism at work, the substitution of institutional trust with political power. It can function briefly, but history suggests it rarely ends the way its architects expect. And as this mechanism unfolds, the risks don't stay contained. They accelerate toward a second, more dangerous escalation. The danger intensifies when ambition expands faster than constraints. Trump's comments didn't stop at oil fields. They moved almost seamlessly into territory. Greenland, control, the easy way or the hard way. This is the second crisis because it reveals something deeper than a single policy proposal. It reveals a worldview where economic assets, energy flows, and national borders blur into the same strategic equation. For markets, this is destabilizing. When investment decisions become entangled with territorial ambition, uncertainty multiplies. Allies question intentions. Institutions feel pressure, and private actors realize they are being pulled into conflicts they cannot hedge against. The oil market is global, but it is also psychological. Prices respond not just to supply, but to fear. Fear of disruption, fear of retaliation, fear that rules are being rewritten in real time. This is how a plan designed to lower prices risks doing the opposite, by injecting geopolitical shock into an already fragile system. And while executives debate risk models and legal frameworks, there is a group with no room to maneuver at all, because when grand strategies collide, they always land hardest on ordinary people. If you are watching this as an abstraction, pause for a moment, because for millions of people, this is not strategy. It is survival. If you live in Venezuela, oil is not a chart or a policy lever. It is electricity that fails, jobs that vanished, hospitals without supplies, a future postponed year after year. When leaders talk about rebuilding and security, you are not thinking about geopolitics. You are thinking about whether stability will finally last longer than the next announcement, whether this time is different or just louder. And if you live outside Venezuela, you are still part of this story. Cheaper gas, lower inflation, promises that global markets can be engineered from above. These ideas feel distant until they break. This is the human cost of uncertainty. When systems collapse, people don't experience transitions. They experience shocks. If this analysis resonates with you, share it. Because the more people understand how power decisions ripple outward, the harder it becomes to ignore their consequences. And those ripples don't stop at borders. They move outward into alliances, markets, and the global balance itself. Beyond Venezuela, this proposal sends a signal quiet but unmistakable to the rest of the world. It tells allies that economic cooperation may now come with political strings. It tells rivals that energy is no longer just a commodity, but a lever of control. And it tells global markets that sovereignty itself may be negotiable under pressure. The reaction is not immediate panic, it is recalculation. Oil-producing nations begin to ask whether today's partnership could become tomorrow's supervision. Importing countries wonder how reliable supply will be if energy policy is folded into geopolitical ambition. Institutions that once stabilized expectations start to feel thinner, more fragile. This is how systemic risk spreads, not through a single decision, but through altered assumptions. Trust weakens, hedging increases, capital becomes cautious. Even the promise of lower oil prices carries a paradox. If achieved through coercion or instability, those prices become volatile by definition. Markets price in the chance of disruption long before disruption arrives, and as these pressures accumulate, the question shifts from whether this strategy works to what happens next if it doesn't. Because when systems are stretched this far, the future rarely follows a single path. Looking ahead, there are three paths this story could take. Each reveals something different about power and its limits. The first is the optimistic scenario. Security guarantees hold, legal frameworks change, investment cautiously returns, oil production rises, prices ease, and Venezuela begins a slow, fragile recovery. In this world, political pressure succeeds where markets once failed, but only because institutions finally follow. The second is the muddled middle. Some investment arrives, heavily protected and tightly controlled. Production increases, but uncertainty never disappears. Oil prices fluctuate, capital remains hesitant. The system functions, but never stabilizes. Then there is the worst case. Security promises weaken, political control tightens, international backlash grows, companies retreat again, this time faster. The experiment ends not with reform, but with deeper mistrust. These are not predictions. They are reflections of how systems behave when pushed beyond their design. Markets can absorb risk. They cannot absorb ambiguity forever. And this is the bridge to the final insight. Because beneath all three scenarios lies the same question, one that defines our era. Who really governs the world now? States or the systems they depend on? This moment reveals a truth many prefer to avoid. Power today is not measured by how much you can command, but by how much trust you can sustain. Trump's Venezuela proposal is bold because it assumes authority can replace confidence. That security can substitute for institutions. That markets can be bent long enough to reshape reality. Sometimes, briefly, they can. But systems remember. Capital remembers where it was burned. And trust, once lost, does not return on command. For you watching this, the insight is simple but unsettling. The world is entering an era where political ambition is running ahead of institutional strength, where leaders promise control in environments built on uncertainty. That gap between promise and structure is where crises are born. If you want to understand how future shocks will unfold, pay attention to moments like this. Not because they always fail, but because they reveal the limits of power before those limits are tested. If this analysis helped clarify how economics, politics, and human cost intersect, stay with me. Share this conversation and watch what comes next. Because the next chapter of global power won't be decided by speeches, but by whether trust can still survive them.